Some media outlets predicted up to a 30% drop in the property market in the UK. Let's see how my portfolio did in 2023. To give you a bit of context, if you're new to the channel, my name is Jamie York. I've been a property investor for about 10 years now, and we typically, between myself and our investors, take on around 200 properties every single year. This year has been exactly the same. We're finishing up at around 250 properties. So let's see how we did. So we stuck with the fundamentals this year. We decided to take out the noise. The only things that I looked at to adapt the strategy over the year was market analytics, interest rates, and inflation. That is it. But Jamie, what about the Sun newspaper that said it's going to be a 25% drop? Yes, fuck off. We don't take account of any news articles. We don't take account of any fear-mongering whatsoever. Why? Because property isn't a short-term return. Anybody investing in a buy-to-let property, and I love my boring vanilla buy-to-lets as you know, shouldn't be investing if they're looking at the 1-year horizon. We need to look at the 5 and 10 year. So did the types of properties adapt this year? No. Funny enough, we stuck to our target criteria. It's our trademarked approach to investing in property and has been for almost a decade now. So specifically, we focused on 2 to 4 bed properties. Predominantly, most of our personal portfolio ended up being 3-bedroom properties. We have been buying more in South Yorkshire this year. Typically, we focus on West and South Yorkshire, but it just so happens more purchases come from South Yorkshire. I think that's an element of not really a deliberate move on our part. It's not just us buying, it's our investors, and we have a priority list for our investors. So annoyingly, the downside of doing what we do with portfolio building, we have to prioritize other people's purchases over our own. Bit of a downside of the business, but it means that for you, if you were one of our Aspire Property Group investors, you know you're getting prioritized on that. So we ended up buying more in South Yorkshire than West Yorkshire this year, with the average purchase price at just over 131,000, well, it's 131,250, and an average rent of £733. So typically we're purchasing between 80 and 160, but in general, at Aspire, we're trying to buy like the higher quality properties. And the reason for that is that most people think the way you make money purchasing property is from the rental return. I'm going to quit my job through property. Yes, okay, that's the bullshit a lot of gurus will be selling you, but the reality is that actually you're looking at the long term. And by the way, to give you an idea, we did a comparison metric between people that were buying lower value properties but higher rental returns as a percentage. So they were like, yeah, but you're only getting £100 a month and we're getting £170 a month. That is great. Congratulations on your extra £840 a year. But over the 10-year period, let's say rents didn't change at all, they're making an extra £8,400 and losing £58,000. What? How does that happen? Because of something called capital appreciation or capital growth. So we deliberately pick properties in those higher growth areas. And if you stay to the end of the video, I'm going to show you how that turned out from the worst areas of the country, where most people go for, and the best areas of the country. And I'll tell you now, the top 5 areas in the UK, we invest in 4 of them in 2023. Just to give you an idea before we go into some top tips and get some locations for you in this, I want to tell you how much it has actually impacted us by picking these right areas. So our cash flow dropped this year in terms of a property or a unit by unit basis. That doesn't sound good, right? Well, the reason for that is the interest rates going up. So we knew the low interest rates couldn't last forever. And by the way, just so you know, we still have low interest rates. It's just a bit of a shock to the system. But just so you understand why, inflation is like being in the car and in the accelerator. It's good going fast, it's enjoyable, we want to grow, but too much speed, you get out of hand, you lose a bit of control. Then what happens is we need to apply the brake a little bit, and the brake is interest rates. So the Bank of England puts up the interest rates, applies the brake, and slows us down a little bit. So it's a very deliberate move. So we knew when inflation got a little bit out of hand, we needed to put the interest rates up to slow the car down, slow the country down a little bit. So what opportunity does this bring? Well, first of all, the natural bullshit news articles come out and fearmonger all of the newbie investors. 30% drops. Now's the worst time to buy ever, blah, blah, blah. There's going to be drastic. Yeah, if in doubt, zoom out. And there has been a never, ever has there been a 10-year period where property prices have gone down. Why the fuck would it start now? Yep, and yet people get scared. And Warren Buffett says, get greedy whilst other people are scared, and get scared whilst other people are greedy. And so other people are scared, time to get greedy. Now, in some areas, in fact, in the worst areas, newbie investors would be buying because they can get a discount. But it's not really a discount, it's just the current pricing mechanism in that area. The smart investors don't think about discount at all. In fact, like, the more sophisticated you get as an investor, the more ridiculous the idea of discount gets, by the way. So what we do as professional investors is we now get access to some of the best areas with less competition. I'll say that again. Interest rates are higher, which means it costs more to own a property. Your competition isn't really other investors, it's first-time homeowners that can spend more money because they're an emotional purchase. But because the interest rates are higher, it makes it harder for them. They can afford more, they wait to sell their property, they wait to buy a property, and so the market ends up with less demand and more fear. But the counter of that is a lot less supply coming to the market. So you'll notice 2023 figures versus 2022, we've actually bought and sold a lot less than usual as a country. So we'll finish at about 1.1 million houses versus 1.3 to 1.4 million. But that's not just because lower demand, it's because there's not enough stock in the first place. So if you buy in the right areas where there's that supply resistance, and I'll go into this in more detail in a moment, you are actually protecting yourself on the downside of the market. So what were the overall stats in the UK? Well, we ended up with about a 1.6% drop, give or take, in the UK. How did that compare to our areas? Well, we actually got a 2% rise in our areas. Now, 2% is not great, by the way. It's not crazy good, but it's a correction type market. And 2024 will be a correction market as well. So your aim isn't to drastically increase the value of your portfolio. What it is to protect yourself and prepare for the next level of growth. So if you're in a market where the market overall's dropped and you've gone up, what do you think's going to happen when the market rebounds? Well, yours will too, but it will be at the top of the market. Now, how do you make money? Write down this formula. You've got rental income plus capital appreciation plus rental increases times leverage. And that's the calculation that we use at Aspire Property Group to purchase our portfolio. Leverage is the biggest indicator. That's using mortgages to leverage your money. You don't need to be buying cash. You can leverage a portfolio. Sometimes you might buy cash and then refinance on it. But the biggest indicator on the rent, the capital appreciation, and the rental increase is capital appreciation. Now you might think, why is capital appreciation the biggest denominator in increasing your wealth? Well, the reason why is, let's say there's a 5% increase on rent. Let's say you're making £1,000 a month and then you're making £1,050 a month. It doesn't really do anything else apart from increase the £50 a month to £600 a year. But let's say there's a 5% increase on the capital value of the property. So it goes from £100,000 to £105,000. Well, because you're using leverage, usually at 75% loan to value, you've got that 25% deposit. Let's call it 25 grand. Let's assume there's no more fees just for the example. So that £5,000, which represents 5% growth, is actually a 20% increase on your net wealth. 5,000 over the 25,000 is 20%. So capital growth, if you get that right, has the strongest indication. Now, how much does it actually impact people? Well, I can tell you, in 2023, our personal net wealth went up over $500,000 a month. Okay, that's us as individuals. The investors, obviously a lot more, but $500,000 a month, and a lot of it, in fact over 80% of it, was through capital appreciation. So the big thing and the big commitment that we work towards at Aspire is trebling our investments, okay? Trebling our income over a 10-year period. So if I've got 100,000 to invest right now, I know that by investing in our areas, and I'll give an analogy in a moment, we will treble that investment. So when an investor, say for example, you've got 100,000 and we build your portfolio, it's not just building your portfolio that we do, it's the deep dive market appraisal. So when we look at a selection of the properties that we own, and then you compare it to the properties that our investors own, it's all in the same areas. We don't cherry pick, we don't do that. And it's because we know we've got the best area analysis, I believe, in the UK that allows us to seriously make money. So if you've got 100K, that will turn into 300K in 10 years. And then obviously you keep building up and building it up. And genuinely, if I said treble your investment in 10 years, most people think, oh, that's cryptocurrency, or you're relying on a stock when you've got this internal tip. No, safest houses, bricks and mortar, boring, vanilla, buy-to-let properties. And by the way, if you are watching this and you've got that 100 grand to invest, even 50 grand to invest, we can get you started with that first property. Put APG in the comments. That stands for Aspire Property Group. So APG in the comments. We'll put a link in the comments as well and pin it to the top. Fill in your details and we will put on a free one-to-one strategy session where we can help you work out and hopefully help assist you build your portfolio in 2024. The analogy I like to use is a tree. So when you're investing in property, you need to think of the long-term fundamentals. So any other stock, like if you're just buying a stock for a quick trade, great. You're looking at a price discrepancy, right? But when you're looking at buying anything for the long term, like Warren Buffett does, you're looking for market fundamentals. So if you visualize it, we call them Vine Street properties. So if you remember Old Kent Road, Mayfair on the other side, and then Vine Street is your perfect investment. The Mayfair is just, yeah, they're nice and glossy, but they are terrible investments. They are the top of the tree, and I'll bring that back. You've got Old Kent Road, which is kind of like the dead leaves on a tree, where they're more flexible, they're faster moving, but ultimately heavily damaged at the fundamental core. And then you've got Vine Street, which is the actual core of the tree, the, what's it called? Trunk. The actual core of the tree, the trunk of the tree. So let's bring it back to the analogy, okay? The market fundamentals, the macroeconomics is like the wind. So when we go through a recession, it's hurricane season, everything's going crazy, everyone's like, fear-mongering. The truth is, you've got the dead leaves that get absolutely crumbled. They were shit when you bought it, they're shit when you sell it. The 50 grand properties in the Northeast Mining Village will always be 50 grand in the Northeast Mining Village because that's what the area is, unless something dramatically changes, which it won't in the next 10 to 20 years. You've got the Mayfair properties, which is the top of the tree, the leaves. And they're great when things are great. They're beautiful when things are there. You've got the photosynthesis, you've got the rain hitting them. It works really well. But when the hurricane hits, they are the first leaves to get stripped off the tree. Now, just because you've got this thick trunk, your Vine Street investment, does it make you invincible? No. But most of the time, you'll notice that the trunks weather the storm. And that's our investment strategy. We're not looking for the dead leaves that are flexible. We're not looking for the top of the tree, the leaves. We are looking for Vine Street, solid trunk investments that fit our trademarked target criteria. And that's how we're able to beat pretty much any other investor in the UK over the last 5 years. And consistently over the last 10 years, we have trebled those investments, and our long-term predictions are to do a lot better than that. But conservatively, we treble people's investments by following this strategy. Now, what's happened in 2023 that we've had to be taken account of? Well, first of all, legislation. We've got a lot of people in government, and I'm not here to knock government. I'm not making out their job is easy, but there's a lot of fucking idiots there right now having an opinion on things that they don't really know about. And so we've seen like the EPC changes come and then go, obviously. Section 21's getting scrapped once Section 8 notice. Could be a good idea, could be a bad idea. Renters reform. All of these changes in legislation has really meant that we've had to be the top of the game. So a big move that we made in 2023 is to bring property management in-house. So I now have a team of 5 people dedicated to this. And the reason why is that we noticed the quality of lettings and management agents plummeting around us. They just weren't able to keep up with the legislative changes over the period. And it has a dramatic impact, because if you're the owner of the property, you're ultimately liable. So we decided, you know what? We'll de-risk, we'll bring everything in-house. It's not a business I love, if I'm completely honest with you. It is a loss lead business, but it means we can have control over the quality for our investments and, of course, your investments if you're one of our investors. The other thing is, in 2023, we've had more weather changes than the last 15 years. So we've had it really hot, really cold, storms, snow, rain, everything this year. And that has a dramatic impact on property, because you have to bear in mind that a brick is like a very slow sponge. So if it's raining over a period of time, it's absorbing that. So we've had to increase inspections on that. And again, another reason we bought it in-house is because letting agents don't always inspect the property when they're meant to. So we're visiting way more often, having to keep on top of it, look at all of those, check the boilers more often, and make sure it's well insulated. So they're really the big things that we've come up across, is the legislative changes and the impact of weather, and of course interest rates to be dynamic on that. So yeah, we've done pretty well overall. And I tell you that actually in the top 5 areas that have performed in the UK this year, we're the top 4 of the top 5 we were investing in. One of them we didn't get a hold of, which was down near Nottingham. And actually what's really interesting is, this may be a bit bitter, but I don't mean it in a bitter way. A lot of investors that were coming on with us that decided, actually, no, I'm going to go for this area because this person promised a 5% discount. And we said, do not go to that area. Those areas were actually in the bottom 5 of the UK. So a little bit of, cockiness there, I guess, is saying it. But the reason why I say it is, whether you invest with us or on your own, it's absolutely great. Just make sure you're not going for the quick wins. Invest in market fundamentals and focus on the 10-year battle plan, not the 10-month battle plan, and you'll be okay. As I said, if you're watching this video and you're thinking, I really want to take advantage, because 2024 is the best window of opportunity that I've seen since 2007, and you're going to have 80% of people acting in fear, 20% of the people taking the action and absolutely raking in the profits because of it. If you want to be one of the 20% to take action, but you're not sure you've got the knowledge, maybe you just want a bit of guidance, then put APG in the comments. I will try to help you as much as possible. We'll have a one-to-one phone call with myself or one of my team, and we will help you build this portfolio in 2024. If you're new to the channel, you know what to do. Make sure to hit the subscribe and the notification bell. I release new videos on property investment based on real-time experience every single week, and I'd love to have you here. Hit the subscribe button and the notification bell, and I'll see you in the next video.